Hey, good morning, everyone. Welcome to Morning Kappa. Before we begin, I would like to highlight a brief disclaimer. Trading in futures and options involve a high level of risk due to leverage and is not suitable for all investors. This presentation is intended for educational and informational purposes and it does not constitute an invitation or recommendation to buy or sell any financial instruments. Please consult your licensed broker or financial advisor before making any trading decision. Let's start. Well, the FKLI currently displaying a resilient but exhausted profile in late January 2026 after a strong rally that pushed the underlying FKLI 7-year high to 1712 last week. The index has run into a wall of profit-taking. Traders are struggling to keep the index above 1710 level as the pull from global volatility offset a general positive domestic economic narrative. And for CPO futures on Bursa currently is navigating a soft and range-bound environment as of late January 2026. After a rally in late 2025, prices have faced a reality check following an Indonesian decision to scrap the highly anticipated B50 biodiesel mandate. Benchmark futures are currently hovering around 4,000 to 4,100 per ton level, struggling with elevated inventories in Malaysia and a lack of aggressive demand from key importers like China. And as of Hong Kong, while US market are panicking over new trade threats, the China and Hong Kong markets are holding steady, while the Hang Seng and China A50 have retraced from their mid-January peaks. They are showing relative resilience. This decoupling is driven by China 5% GDP growth confirmation for 2025 and an influx of domestic liquidity as households shift trillions in maturing deposits into equities. However, the shadow of new US tariff threats remain a persistent weight on sentiment. As for Dow Jones, S&P, and Nasdaq, US equity futures are currently navigating a milestone fatigue phase. After a blistering start to 2026 that saw all three major indexes hit highs in early January, momentum has cooled. The S&P is struggling to reclaim to psychological level of 7,000 handle, while the Dow Jones is starting up at the historical 50,000 mark. The Nasdaq is currently trapped in a symmetrical triangle. A decisive daily close below 25,000 would signal a deeper correction towards the 23,350 area, while a break above 26,000 is required to reestablish the bull run. Well, the major US indexes, Dow Jones, Nasdaq, and S&P are exhibiting classic sign of technical correction. Current price action favors short-term bearishness, making a sell on strength approach the high probability play. Traders should look to initiate short position on rally towards establish a resistance zone rather than chasing the high at current low. As for Nikkei is catching its breath after a record-breaking run, while the long-term story for Japan remained very positive due to government spending and a better managed company. The short term is messy. Rising interest rate and an upcoming election have made investors nervous, causing them to lock in profit. Think of these as a healthy pause in marathon. The market is looking for a solid ground around 51,000 before deciding if it has the energy to climb back to the 54,000 level and beyond. And for corn corn market is currently drowning in rain. A record-breaking US harvest has filled silos to brine, keeping prices at multi-level low. While you might see some small price jumps if the weather in Brazil turns dry, the massive amount of corn already harvested make a big rally unlikely in the short term. So farmers are likely to plant less corn next year because it's becoming less profitable, which might help prices recover later in 2026. Soybean oil has started to bounce back from recent low and has settled back above 50. Demand across the global edible oil market, supported by the strong palm oil prices and steady import interest, is helping stabilize the outlook. We will keep soybean oil on our watch list for potential upside as long as the rebound holds. Well, for soybean prices are currently stabilizing after earlier weakness, but abundant global supply continue to limit upside. While demand remains steady, especially from China, the market needs a clear catalyst, such as weather disruption or stronger export demand, to break out of its range. For now, soybean remain a watchlist market for a neutral outlook. Well, we are going for a precious metal, especially in gold, silver, and copper. Gold prices recently climbed to over 4,700 per ounce, making new all-time high amid heightened market risk. On January 20th, gold again surged, approaching 4,735 per ounce, as strong safe haven demand lifted prices. Central bank buying, tight supply condition, and investor demand for stability has been cited as contributing factor behind the upwards trend. Rising geopolitical tension, including trade war and uncertain global relation, has pushed investors towards gold as a traditional safe haven asset. Market anxiety over trade policy and risk in equity also encourage flow in precious metal. Silver, the star product, silver prices have surged sharply, climbing above previous historical peaks and touching around 95 per ounce recently, yesterday actually, as metal market remains strong. Silver rally is supported by a combination of persistent supply deficit, where demand outpaced mine output, and strong industrial use in solar panel, electric vehicles, electronics, and other clean energy technologies, which we have tightened the market. Investors are returning to silver not just as a precious metal, but also as a portfolio hedge amidst macroeconomic uncertainty, geopolitical tension, and expectation of central bank rate action. Silver rally has coincided with record highs in other metals like gold and copper, reinforcing bullish sentiment across the sector. So we will continue to see upside momentum on silver. Strategy remain to buy on dip as long as the bullish trend holds. And for copper recently hit record prices above $6 per pound as demand from key sectors like electrical vehicles, clean energy infrastructure, and data center surge. Supply disruption and optimism for long-term structural demand have supported prices. After this high, some profit taking has emerged. Analysts from major financial firms have suggested that the rally may have temporary peak and that prices could pull back before resuming direction. And for crude oil has trading in relative tight range within 55 to 62 since October. Although recent price action shows sign of rebound, it remains unclear whether it will develop into a sustainable uptrend. However, it is worth to watch under the radar. So, well, natural gas. Natural gas, we actually revised our outlook on natural gas from bearish to neutral, as the market has started to rebound from the recent low since Monday. Natural gas futures has been rising sharply over the past week, driven primarily by strong demand expectation from colder than normal weather across the United States. Forecast for extended Arctic outbreak and colder condition in the Midwest to East Coast have pushed the heating demand higher, prompting traders to lift prices significantly. So as for the last one, WTI, oh, sorry, and for FCPO, like we mentioned just now, CPO has been in a very tight range at the moment. Resistance is around 4,150. So whether CPO can break out for an upside, it really has to break above this level 4146 to be stabilized above 4146 in order to continue for an upside. And WTI, we are actually making, WTI is actually ranging around 55 to 62, but at the moment we saw some support above a 58 level. So yesterday market went to around hovering around 59 to 60. So we would like to make a short-term call. Our first call on a micro WTI crude oil, which WTI Brent oil and crude oil prices have trended higher as a geopolitical instability in the Middle East and a question regarding OPEC Plus output reignite this supply concern. This shift has effectively baked a higher risk premium into a short-term pricing. So therefore, consequently, our first trade recommendation of the week is WTI, where reference price at 60.05. Sorry, our reference price at 59.57 and our potential profit target at 62.5 and potential loss at 59.05. So this is like an investment of initial investment of 400 USD with a potential profit target at USD 293 and a potential loss at USD 100. Next one, we are making a second call. On Monday, we issued a trade call for micro natural gas at a reference price of 3.47, and this position target a potential profit level at 4.89 and a potential loss at 3.3. So meaning this will be the total investment of USD 400 with a potential profit at 1,420 and a potential loss, a risk exposure of USD 170. This call we have made on Monday. So price now is at 3.88. So there is still room for upside, but you really on your own discretion for trading. Any price that you enter, you will have to go back to the potential loss price at 3.3. So that's all that I have to share. Thank you. Well, over to you, Aiman.
All right, thanks, Meagan. Right, morning, everyone. Okay, so for the S&P 500, well, it tanked yesterday, over 2% on Tuesday session as the 10-year Treasury bond yield surged to 4.295%, forcing the investor to dump the expensive tech stocks on fear that the interest rate will stay higher for longer. So I think sentiment was crushed by the Goldman Sachs, which missed earnings expectation due to the sharp rise in the bad loan provision, which also signals that the US consumer is starting to crack, right? Which dragged the banking sector is down. Also, I think the tariff threat over the Greenland was one of the factors dragging down the Wall Street, in which Trump says that he will work hard to take the Greenland, regardless of how hard it is. So I think expectation for today, right? Do expect for the selling pressure to continue towards well, at least 6,700 points in the coming session. Yeah, I think the market shifted from greed to fear right now, until the sentiment cool off at this juncture, right? So for the China A50 futures, well, it dropped yesterday to 15,026 points. On Tuesday, as the PBOC keep its LPR unchanged, all right. Which also disappointing traders who has aggressively positioned for the rate cut to boost the property sector. So sentiment worsened late in the day due to the geopolitical headline as well, threats of for the new US tariff on the over the Greenland, which causing a sharp sell-off in the export heavy names. And the communication service sector dragging the index down as well. So for today, right, expect the A50 to test at least the 15,000 points level with the monetary easing of the table for January. So for now, we see that 14,700 a strong support for any hiccups from the market if it also has crossed. I mean, for these futures, it has also crossed the minor downtrend line yesterday. So we have Hong Kong trading stocks that we publish, right? So first we have Zijin Gold International, stock code 2259. So the stock has break up above this 175 resistance level. So if the bullish momentum to remain steady, we expect at the price to test the next resistance at 190 HKD before it climb higher towards the 205 HKD. Hong Kong dollar, right? So now if the momentum to reverse lower, make sure to have a stop loss at 160 Hong Kong dollar, as it indicates a possible change of trend, which might also affect your trades, right? So next we have PopMart International, stock code 9992. And if you see here, the stock now is starting to climb higher after this rebound right here. And now, if the price is able to continue to maintain higher, it may reach 215 before it propel higher towards the 230 Hong Kong dollar. So a reverse below 185 will open the door for a deeper correction, shifting the trend lower, right? And also for the WTI futures crude oil, right? So it closed flat yesterday at 5949 or 5950 dollar level on yesterday's session, as the I think because of the conflicting news, right? Which the I would say crash in not crash lah, but a bearish movement in the S&P 500 and a strong dollar, which raised fears of the demand slowdown. And also there's this news on the losses were recovered by a surge in the heating oil futures, as one of the meteorologists confirmed that the massive deep freeze will cover the US Northeast for the next week or 10 days, forcing the utility companies to burn oil for power. So yeah, I expect the bullish move today, right? Driven by the API inventory data. And at this juncture, still keep our positive view for WTI, eyeing for this $62 level. And if this level able to breach higher, we are looking at $65 dollar level. Right. So for the Malaysia market, well, for the KLCI, well, it dropped significantly on Tuesday as the fund sell-off hit the bank overweight, right? I think if you can see here, CIMB, Maybank, Public Bank, right, were dumped due to the worsening risk sentiment from this China, and also I think while the broader market was weak, some of the names like aviation sector bucked the trend, like Capital A. We have AX rally on a strong Chinese New Year, travel booking numbers, which also offering a rare, you know, uh, bright spot right here. And same goes to FKLI. Well, it continues to take a breather lower, below this 1730 points. But riding on the overall broader picture, we are positive and looking closely if the coming session could rebound from this 20-day SMA line. So for Malaysia market, I think expect the index to struggle a little bit before it could revive in the coming session. And I think the massive, not massive, but the significant red candles right here, right, for the finance sector index or the banking stocks, okay, could signal that the smart money is moving to the sideline until the US earnings stabilize, right? So yeah, in terms of the sector performance day to day, well, all sector retraced yesterday. However, if we were to eliminate out these rates in the heat map, right, from the recent session, well, to see I mean, for us to see where the smart move goes, so we can refer to the size of the box right here, and as I have set up to the price times volume setting. So from here we can see that the transportation, also the consumer, right, could have potential for today's trade. And looking at the watch list right here, we have highlighted some of the sector, right? And also, moving on to our Malaysia trading stocks. So today we have SP Setia. So the stock is on its pending breakout at the 85-cent level on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel to test the next resistance at 90 together with the 95-cent level. So if the stock to clear below the 80-cent support, I think this could reverse the trend and to move lower, right? And also we have Mr. DIY. So the stock is experiencing a breakout at the 1.70 level. So if the stock to remain bullish, we're expecting that the price or the stock to reach 1.85 in the coming session with high volume as well. Second resistance is at 1.95 level. So do keep an eye at this 1.60 level for any attempt of reversal. Right, so I think I'll stop here. That's all I have for today, and pass the floor to Sian. Thanks everyone, and happy trading.
Thanks, Aiman. So good morning, everyone. Just a quick update on Malaysia trade data for December and also inflation data for the month of December. So overall, we do see that there's a solid end to 2025 based on the market recent macroeconomic data releases. So Malaysia trade performance ended 2025 strongly with double-digit growth in exports and imports. With recent update macro data, we maintain an overview that the OPI is likely to remain unchanged at 2.75% at the January MPC meeting, which is scheduled to be held on tomorrow. So, and then moving on. So, given the risks on external front have eased. So, with external demand expected to be supported by easing tariff-related risk, continued resilience in E&E exports, and improved clarity on reciprocal trade policies from US tariff policy developments are likely to be we are seeing that the risk on external front has eased, with external demand expected to be supported by easing tariff-related risk, continued resilience in exports, and improved clarity on reciprocal trade policies following the conclusion of US and Malaysia reciprocal trade agreement. So over the medium term, so we are seeing that the potential downside risk from US tariff policy developments are likely to be mitigated by official efforts to diversify export destination, alongside with continued policy support for the companies as well. So in 2025, the export has actually rose by 6.5% on average, which is in line with our in-house projection. So while the imports has actually increased by 6.2% as well. So our positive outlook for 2026 is reinforced by the robust trade data, and we expect this momentum to continue in this year. So with export growth projected at 9.3% for 2026. So in detail, December export actually has increased by 10.4%, which is higher than November's print of 7% and way higher than market consensus of 2.5% and marginally lower than our in-house projection of 10.7% for the month of December. So by destination, we have also seen that export performance has continued to record growth in key destinations such as US, EU, and Hong Kong, as well as some of the ASEAN countries. So by products, the manufactured export has also surged by 13.6%. So underpinned by increased shipments of E&E, as well as machinery and equipment related products as well. So on a separate note, we have also seen that the inflation still remain manageable. As for 2025, the inflation has also increased by 1.4%, which is lower than historical average of 2%. So December CPI in detail, inflation has come in at 1.6% as per the DOSM data release on yesterday, slightly higher than November's print of 1.4%, as well as our in-house projection of 1.5%. So meanwhile, the core inflation inched higher to 2.3%, so signaling persistent underlying price pressure and also a resilient domestic demand as well. So on this year, so we still maintain our view that inflation is projected to rise slightly to 1.8%, so reflecting steady investment, resilient consumption, and expansionary fiscal measures. So despite this, inflation is still expected to remain manageable, so still below the long-term average of 2%. So due to orderly policy implementation and moderate global commodity prices. So we are seeing a stronger disposable income in this year, especially following a resilient and robust labor market, where recently unemployment rate has trending now to 2.9%. So coupled with we are seeing a second round of servant salary adjustment in this year, enhanced consumer support, and also including higher direct cash aid of 15 billion in as per budget 2026, and also a second 100 ringgit SARA payment by February this year. So, and potential subsidy rationalization for food items might raise the food inflation, however, but overall spillover should remain contained if implemented gradually. So that's all from me. I will pass the stage to the next presenter. Thank you.
Okay, thanks, Sian. Good morning, everyone. We have a report out on Maybank today. This is based on yesterday's Investor Day, where Maybank unveiled its new 5-year strategic plan called Raw 30. Now, this Raw 30, the key thrust, really, there are 4 core business areas Maybank is going to bank heavily on. Firstly is on global Islamic finance, to raise contribution from Islamic banking financing, as well as to bring in Islamic wealth fees. Secondly is for regional wealth management, of course, to grow the wealth fee income. Thirdly is transaction and payments banking, which is going to be positive for non-retail CASA, as well as global banking income. And fourth is on corporate investment banking, to really cement its position as the leading regional player. It also highlighted that it will continue to invest in its technology. They are setting aside 10 billion ringgit for OPEX as well as CAPEX over the 5-year period. Now, with all these strategic trust, what are the key outcomes? The main one really is the 2030 ROE target of 13 to 14% from the 9-month 25 ROE of 11.5%. Supporting this ROE expansion, 3 things. Firstly is a 5 to 6% CAGR in terms of operating income. This will come from slight margin expansion, as well as better fee. Secondly is a cost to income ratio improving to below 47% from about 49% currently. while there is some technology spending and that will put upward pressure on OPEX, there are also cost optimization initiatives that Maybank plans to embark on to actually cushion the impact. And thirdly is credit costs, where they intend to or target to keep it at the low 20 bips. Other Q&A highlights now, this ROE target that they have set is based on organic. No capital management initiatives there, or rather there's no capital management initiatives that was announced, because they said, they will actually give more details in the upcoming February results briefing. Apart from that, Indonesia is going to improve. As you recall, they were doing some rebalancing on the loan book away from the low margin state-owned enterprise lending, and that is almost done. And thirdly, I think the third key message from the Q&A is that management incentives. This is really tied to ROE. It's a key financial metric, as well as total shareholders' returns. So very much in line with investors. No change of forecast for now, pending the results next month. We have, however, raised our target price by 9% to 12 ringgit and 35 cents. This is because we believe a mixture of liquidity inflows, positive macro outlook, as well as some stronger earnings momentum ahead will be supportive of valuation expansion. So we stay buy on Maybank with a new target price of 12 ringgit 35 cent. The previous target price was 11 ringgit 30 cent. Okay, thank you. That's all from me. I'll pass you over to Eddy.
Thanks, David. Moving on, we have a sector update on the rubber glove sector. We are maintaining our underweight stance as we view the sector current valuation appeal, which is on the price to book basis, as secondary to the looming risk of earnings misses. We think the sector narrative remains dominated by a pricing power deficit. I guess, with glove producers caught in between a strengthening ringgit as well as intensifying global competition. And we also see downside risk to our FY26 earnings forecast, as we have yet to fully reflect our latest in-house assumptions for USD MYR into our forecast. And we see demand and supply not quite equilibrium yet. Our 2026 base case assumes that the demand actually stabilize, and we assume a stabilization in global rubber glove consumption following the normalization of inventory levels, right? That being said, demand for glove is expected to grow at 8% to 400 billion in 2026 and 6% to 424 billion in 2027. This will be driven by structural improvements in global hygiene awareness. Think about occupancy safety standards. But we think supply could be still an imminent problem. Under our assumptions, we do expect a more balanced demand and supply dynamic to emerge by 2027. But this outcome is highly contingent on the absence of further capacity expansion announcement, particularly from China-linked producers, which could go up to 80 billion pieces per annum, right? In terms of ASP, management commentaries across briefings, they do suggest a continued ASP pressure going into 2026, which could be potentially exacerbated by incremental supply from China glove producers with offshore facilities. And compounding this pressure, we do have rising raw material prices in the past couple of weeks. Also, while a weakening USD provides some relief on ringgit-dominated input costs, it also simultaneously erodes the manufacturer's pricing power, right? So, in a price taker environment, buyers are likely to leverage on the stronger ringgit to resist any price pass-through. Thereby, we think there could be a increase in margin compression risk. In terms of sector valuations, this is still on price to book matrix at 0.9 times. It appears inexpensive, but we view this as a reflection of persistent structural headwinds. That said, against this backdrop, we do prefer players with diversified end markets as well as stronger execution capabilities. I think Top Glove fits the bill here due to its focus on latex as well, which kind of provides a strategic buffer against aggressive pricing from China competitors who primarily dominate the nitrile markets, right? And this niche has allows Top Glove to actually defend its market share through selective pricing and a strategy that has, already yield results. I think based on the latest update, the weekly orders have surged to 1.4 billion pieces, and that is actually exceeding their capacity and has extended lead time beyond 60 days. But we are still neutral on this call, this stock, as we are seeing rising latex costs, which could eventually erode these price margins. The other thing I wanted to highlight is we do have a report on Harta Lega. We are revising our earnings downwards for Harta Lega, and lowering our target price to 82 cents, which implies a 0.63 times calendar year 26 price to book. We do think this appropriately reflects FX risks as well as the still challenging industry outlook. I think for Harta, despite improvements in recent quarters operationally, we remain bearish. Our view is that Harta's nitrile heavy exposure as well as thinner operating margins and greater sensitivity to US market competition actually leave them more exposed to the very headwinds that we have discussed just now. And while utilization rates are high and there's additional lines coming on stream, that doesn't actually solve the pricing problem. And at the same time, when we look at consensus numbers, the expectations remain elevated. And Harta Lega is still the most expensive stock in the sector, trading at 32 times forward price to earnings. This is based on consensus earnings, right? So overall, we are keeping our sell call with a 82 cents target price for Harta. That's all I have for today. Yep. See you tomorrow again at morning kappa at 8. Thank you.